All right, so we're live with a friend of mine, Jesse Liebenthal. He's a local New Yorker. We got to catch up in person a couple weeks ago, and excited to get back on the horn with Jesse. I just thought, the community can learn a lot, and he's been in New York for a while. We connected a while back, and we're able to kind of reconnect. So just excited to kind of hear a lot more about your background, Jesse, your career. Like there's a lot of interesting stuff that your family is working on, especially on your website. You talk about one of the successful exits that you came out of. So excited to learn about that. But then also interesting to learn about some of the businesses that you built as a family. Many LPs come in all different types of flavors, right? Some LPs come from a business background. Some LPs come from like a wealth management background. I've seen, single family offices do really well in the insurance space, and now they're kind of getting into real estate. So there's just so many different ways to think about how capital is allocated. I feel like a lot of times people start with just kind of their background and their career. So for me, I worked in aerospace and then worked in software. So those are kind of the areas that I'm a little more comfortable with. But I also have an open mind, and I know you do too. So, so everyone meet Jesse Liebenthal from Liebenthal Ventures. He's here on behalf of his family office. He's a principal there, and he leads a lot of the venture investing. So, Jesse, why don't you start with just kind of, your family's background, where you grew up. I don't know if you're from New York, what you studied, and then just kind of how you transitioned in your career.
Absolutely. Well, first of all, thank you so much for having me, Joel. I don't know if your listeners know this, but I look at you as the fun whisperer. I mean, this guy's got his tentacles all over the place. So really appreciate you having me.
Thank you so much.
And happy to give some background. So as Joel mentioned, my name is Jesse Liebenthal, principal at Liebenthal Ventures. Went to University of Michigan. I studied IT there. So tech background. And around my sophomore year, this was before I was involved in the family office, my father invested in a company called LoopPay. They quickly had an exit and became Samsung Pay. So for better or worse, highly successful exit kind of right off the bat. And as I graduated college and my dad wanted to get more involved in the startup world, he was already in the real estate world. He has his personal job. He manages he calls it his public hedge fund. So this was kind of like the fourth work stream, if you will, for him. So he didn't really have time or energy to attack the startup world. So that's kind of where I came in. After I graduated college in 2017, I had about 5 or so months in between graduation and starting my day job. And I was like, okay, what am I going to do? Like go be a waiter for a handful of months? I kind of wanted to work on personal skills. So I was kind of up in the air. And he was like, why don't you just see if you can help me out, spend a couple hours a day on it and see where it goes. I did not picture at that time that it would go to where it has today. So as I mentioned, that was the summer of 2017. Kind of started off just, I found this website called digital.nyc, which was, and I'm sure it's still active, but just basically a New York database of startups. I'd go through like my 100 favorite a day or 100 a day, choose like my 10 favorite, cold reach out and go from there. And since then, we've invested in 25 companies. We've had a couple exits back in 2021 when the market was pretty active. Yeah. We kind of invest in about 4 companies a year. It feels like 1 a quarter. We're industry agnostic, so we invest really across the industries. I like to say that we've invested in 26, if you include LoopPay, 26 companies, and none in the same industry. As you mentioned, I'm from New York, but happy to go into more of our thesis and kind of where we've been since then. But kick it back to you.
Yeah. So, it's interesting because AngelList used to have that. I don't know if you remember from like 2012 to 2014. AngelList used to have like a list of startups. Now if you look at their website now, it's like, hey, launch a fund, let's do your fund admin. So why do you think that AngelList stopped showcasing? I think they still probably have the jobs page, which I think got acquired by somebody else. But why do you think they stopped because I thought that was a great platform. to just find deals? And why do you think there's not more startups kind of doing that, just kind of aggregating all the great startups out there?
Yeah, so great question. So I think, first of all, you look at AngelList, you look at PitchBook. I think AngelList was looking at Crunchbase and PitchBook and saying, wow, they've monetized. We gotta hit the ground running a little bit harder, which, I do feel what's so great about the startup world is it really does feel like a community. Like more than any other industry, people want to help each other. And I feel like helping each other is helping your own companies. So I think there's something beautiful about the startup world in that way. In terms of AngelList, I do think that they were just like, look, we got all of this fantastic information and we are handing it to people on a silver platter, and we're not getting anything for it except maybe some people coming to our website more and launching funds with us, which is of course valuable, and they're collecting fees on that. But I do think they probably felt they were sitting on this collection of extremely valuable information, and they were like, we can't just keep giving it away for free forever, which is unfortunate. Because as I mentioned, it's websites like that help funds like us get our start. When we started, we had no industry contacts, we had no connections. So I'm sure there's a lot of people out there like us that are like, how do we get started? We have some family money, we created a fund, and now we want to kind of hit the ground running and find companies. So I do think it's too bad that they did decide to take that off, but thankfully there's a lot of individuals like me and you that are willing and able to help others.
Yeah. And we're part of some similar communities. So I think for me, I've found a lot of great deals just from other fund managers. So a lot of times I think there's some vetting and diligence already done, which I think cuts through half of the time of priding yourself of like building your own investment team and sourcing and screening and doing all that hard work yourself. So I think that's one of the beautiful things with the fund manager ecosystem, which I think is kind of evolving from like the startup ecosystem. Right before, there used to be a community of founders. And, I'm seeing this with the fund accelerator that I have. There's a lot of funds now that are kind of looking to each other as fellow, I like to call them capital founders, right? They're founders that are building their businesses just like a startup, but it's a business of allocating capital, and, you need a support system. So some of the communities that we're in, we're starting to see that, which is great. How are you dividing your time? So it sounds like you're pretty active, kind of, still using I think, what was it called? Build NYC?
Oh, no, I don't use that anymore, but that was called digital.nyc.
Digital.nyc, yeah. So I guess what are some tools for some maybe new analysts or associates that you recommend that don't cost them? Like, obviously everyone's going to say PitchBook, but, and Crunchbase, I had Crunchbase for a while. I think it was great. It's only like $300 a year, and I think you can download about 1,000 fields, 1,000 rows at a time, which is not bad. If you're doing a filter on like New York-based B2B SaaS startups, you can at least download some, like a limited amount of data from like the criteria that you choose. But I guess any tools that you think are great tools to source deals?
So I think the best place to go is straight to accelerators. Well, I will say it depends on the stage that you're investing in. For us, we invest in seed rounds, early stage. So for us, accelerators have been a fantastic avenue. Go to their demo days, they'll release newsletters. So as you mentioned, that's a great place to find just vetted companies that have good people behind them, that have grown companies before, that have been through the cycle before. So I've really enjoyed my experience with a handful of the accelerators that we've worked with. If you don't, obviously you have to email them and create a relationship. So Y Combinator as well does have on their website all of their companies. And as you mentioned, you could filter through them. You could say New York based, what cohort, what industry, is it generally B2B SaaS? So that's also a great reference tool to just kind of, I'll say, get your feet wet and learn about some companies that are out there. But I do think what's great about the accelerators is you're talking to companies that are currently fundraising. the way that I did it back in the day when I was going through digital.nyc and we didn't have really contacts yet. I mean, I would, as I mentioned, go through 100 a day, choose my 10 favorite. Maybe one of those was actually fundraising, maybe zero. And if they were fundraising, maybe they were earlier stage than we were in pre-revenue. Maybe they were even Series C at this point and had grown a good bit. So I wouldn't say I was wasting a lot of time, because I think that's genuine of me to say. And I think digital.nyc was a great resource for us. But I do think when you're talking and dealing with the accelerators, you're dealing with already vetted companies that you know are raising. You're not wasting anyone's time. And you know they have tools and support behind them, which I think is so important for a lot of these early stage companies that do have first-time founders.
What are some things that you look for in founders, right? So, I mean, you probably have a huge pipeline of deals that you look at. So if you're only doing, around 4 to 6 a year, ideally, how many companies do you like to look at to kind of, obviously have a good pipeline and do your filtering criteria? And then what do you think is a common characteristic that has put you over the line to actually make the investment?
Yeah, great question. So we probably look at about 200 pitch decks a year, maybe 200 to 300. That gets down to that funnel of 4. So there's certainly a lot of things that have to get excluded. So, our thesis is that we invest in companies that have traction, and we try to find as close to 10x revenue to valuation as possible. Obviously, in today's market, that's not that prevalent, I'll say. But they are there, and there are great companies that are raising at very reasonable valuations. So first and foremost, we see a lot of companies that are raising at 200,000, that have 200,000 revenue and are raising at 20 million post-money valuation, and you kind of scratch your head and say why. So those companies will kind of exclude outright. Once we speak to the companies and we meet the founders, we call it the warm and fuzzies index. So when we talk to that founder, can we see ourselves having lunch with them? Do we feel like they have a grasp of their numbers? Because that is so important to us. We don't want to talk to a founder that you say, what's your ARR? And they're fumbling through their Excel spreadsheets to try and find, what's your burn rate? That should be you should know that every single day.
And they should have that as, you may not have it in real time, but at least you should have some high level stats on just kind of average monthly recurring revenue and maybe what your last year's revenue was, right? And maybe some, I would say for me, it's kind of like monthly recurring. It depends on the type of business, right? So if it's kind of a consumer business, I would look at the monthly recurring revenue. But if it's B2B SaaS, I kind of look at the yearly. So I think what's interesting for me, and I love your feedback, is kind of like, hey, here's last year's revenue, here's this year's revenue. It's grown by, I like multiples a little better than percentages. But if it's not that meaningful of a multiple, if it's only moved up a couple of basis points, then maybe percentage is easier to consume. But I feel like it's last year from this year and seeing some level of growth, whether it's at the monthly rate or the ARR rate. But anything else that you think is, helpful for you in your kind of KPI financial analysis process?
Yeah. And I just want to make one more comment on that. I said as close to 10x possible, but there's obviously companies that we see that started about 6 months ago and are at $1 million ARR already. And you're like, okay, yeah, they're clearly growing at an unbelievable multiple. So we can go a little bit over the 10x.
I was going to joke too, because when your dad kind of had that exit with LoopPay, he was probably like, man, this is easy. I could do this all day.
Exactly.
So I think it's great, when you're super lucky in the beginning, but I think it's, that's a very fortunate thing to have happened. But yeah, I mean, I think to your point, right, you're looking at a lot of companies and kind of going through that diligence. So you're ideally looking for companies that are hitting, like 500K in revenue a year?
At least 500K. Yep. That's our kind of baseline. B2B SaaS. So I know you mentioned consumer. We've invested in a consumer products before, or a consumer's company before.
Mm-hmm.
We've invested in a hardware company before, but if you look at our portfolio, 90% of the companies are B2B SaaS type.
Yeah.
And even the hardware companies usually have some type of software component that they're able to license and create some recurring revenue off of. Because that to us is, to not have to make a sale every single day is a nice thing.
Sure. Yeah, no, absolutely.
So that's kind of what we look for. But back to your questions of what else do you look for with founders. One of our biggest pet peeves is when you get that pitch deck and you see that hockey stick.
Yeah.
We don't want to see that you're doing 1 million today and you're going to do 100 million next year. And if you are doing that, you better say that you have signed contracts and a huge pipeline that is actually driving that projection. And it's not just like, yeah, we feel really good about what we're doing. We're going to hit the ground running and we're going to hit that number. And I get that some funds do like to see that aggressive growth projection. To us, we'd rather see reasonable projections that we actually think you can hit. We'd rather see you succeed and if anything, go over your projections, then, which doesn't happen too often, but when it does, it's exciting, rather than vastly over project and be way under.
Yeah. Where do you think the market is heading now? Just your humble opinion, with the election coming, what do you think will kind of happen with kind of the market overall? I think it can be binary in terms of who gets elected, but are you seeing more activity, since the summer? And are you seeing a lot more people leaning in, or, are you seeing people pulling back?
So it's a tough market right now.
Yeah.
I think kind of where we invest, we're probably seeing the least amount of change. But as you go upstream, like looking at our companies, we're doing more follow-ons than we ever have before, just because we feel like our companies that are progressing really well and growing really nicely have really reasonable valuations at, the Series A type rounds. So I think, in my very humble opinion, I do think that 2021 was such a strong year. It was too strong. Clearly, there was a correction.
Yeah.
Now it's probably a little bit more reasonable, but I do think it's going to get stronger in the next year or so. It's always cyclical. The M&A market's been next to nothing. And very few IPOs. That can't be sustainable. The interest rates aren't sustainable. So I do think over the next couple of years, things will come back to a stronger market. So I do think we'll see a lot of money. I remember seeing 2021 was like a record year in terms of the amount of money that was invested in the startup space. I do think I don't think we'll hit that, but I do think we'll start inching our way towards that again.
Yeah. I would say too, it's, with 2021, a lot of the valuations were really, really high. So I think some of the people that were in those price points, especially in secondaries, a lot of them took a huge hit, and then I think some people exited those companies, went into public markets, and they're waiting for those share prices to go back up from so they're kind of catching up, and they're almost like in another venture cycle almost, right? If you think about it, right? If you did like secondaries and you got in at a certain price point and then the IPO was a lower price point, you're kind of down, and then you got to hold on to it in your in your Merrill Edge account or your Robinhood account until it kind of 2X's maybe 5 years from now or something like that. So you're better off I would say, even for secondaries, you're better off just buying, Uber when it IPOs, or like a really hot company when it IPOs, and then just kind of hold it long,
Yeah. And I think it was such a disservice to some of these companies that were able to raise at such crazy valuations, because all their investors were like, we just want to see growth, grow at all costs. We'll give you $10 million, put it to work.
Yeah.
They put it to work, and it didn't go the way that they wanted to. So as you said, they had to have down rounds, and they had to really scratch and claw to survive. And it's funny because looking at that was 2021 in a very strong market, and now we're in a weaker market. And those same funds that were telling these companies grow at all costs are now saying be profitable at all costs.
Mm-hmm. Yeah.
So I think, on one hand, it was a lot of fun to see a strong market, but on another hand, I think it was a cautionary tale to a lot of these founders to say, hey, we got to pump the brakes. Yes, we have this money in our pocket. Doesn't mean we need to hire our entire plan today. We can slow roll it out, make sure we're hiring smart, make sure as we're hiring, our revenue is growing. And if we continue to see that, then we can keep the hiring. One of our companies had that situation where they raised a large chunk of money, put it all to work, got to 100 employees, and now they're back down to 25. So that money would be really valuable to have in their hands right now, and it's got.
Yeah. What would you recommend these founders to do? I mean, so one question I have for you too, before I ask that question is, when you look at follow-on investing, what are some of the criteria that is required for you to decide to follow on? Is it just the growth in revenue at the same? Sounds like it's the growth in revenue at still a reasonable valuation.
Yeah. So for us, we try to look at all of our follow-ons just like fresh investments. So we will put the same parameters in place. But obviously, you have a lot more background and history with the founder as well. Yeah. I think we have all great founders. Doesn't mean that through the years, over 5, 6, 7 years, we've always had the best relationships with some of them. Obviously, we try to be there for them and help, but not always the case. So, part of that follow-on decision is, do we still believe in the founder? And do we have a great relationship with them? And part of it is, if, let's say, we've run into a situation with them where we didn't feel they did the right thing, that'll stick with us. So, of course, we're happy to continue to support them, but I don't know if we'll be as willing to do that follow-on as we might have previously.
Yeah. Okay. That's helpful. I think, definitely looking at it as a different investment is helpful. What are some of the things that you've seen behavior-wise or just, business-wise that have made you have a hard pass? Obviously not knowing your numbers, but what are some other, just fundamental reasons why you've passed quickly?
Great question. There's a few things. So I think probably at our stage, being the size of the fund that we are, we probably do ask for more due diligence items than most. One of the things that we ask for, well, two of the things we ask for are bank statements and tax returns to prove your revenue. We've had companies that we have great conversations with. They say that they're doing great and growing nicely. And when we send that due diligence list, we don't hear from them.
Oh, interesting. Okay.
So that's not even us saying no to them. That's them saying, we're not going to go down that route with you.
Sure.
So that's one thing. Another is anytime a founder is like, round's closing tomorrow, get your money in, like, hey, and we've had a situation before where we've been in due diligence with this particular founder, and we didn't invest in this company, full disclosure. But we were in due diligence with this company maybe like 3 days after we sent them our list. And part of our due diligence items is to talk to 2 founders and two customers and 2 investors. So obviously it takes time to set up those calls and have those calls. It's not going to happen within 3 days.
Yeah.
The founder, literally 3 days after we had our initial call and sent them the due diligence items, was like, hey, we're going to try to close at the end of this week. How does that sound to you? We're like, okay, you could have mentioned that on the first call.
So closing the round, or they're just trying to get you to invest? Because closing a round is a bigger orchestration too, right? So
right, of course. And that we understand. And that, if you tell us up front, hey, like, look, we're trying to be a little quick here. It's the 22nd of July. We're trying to have this round closed by the 30th of July. Of course, tell us that up front. We completely understand and respect that.
Yeah.
But it's when you don't say that, and then like all of a sudden there's some urgency. Like, hey, like we need a decision like today. You're not going to get a positive decision from us, given the pressure. So that's another one of the things that we see where it's like, okay, like pump the brakes.
Mm-hmm.
I think if anything, it kind of scares us a little bit that they are so urgent to get that money. Like, are they running out of cash? So things like that kind of, I'll say a flag goes off in your brain when stuff like that happens, that you're just like, okay, something doesn't smell right here.
So I would say, and I think one of the things that I've heard before is like some of the best times to raise money is when you're not raising money, right? So I think obviously, like maybe you just got your seed round. I think it's normal for a founder to continue meeting other VCs to already think about their next, funding round. They want to bid it, but it takes time to build those relationships, and that way you don't feel too thirsty, right? You're not kind of like on the edge trying to pitch too hard because you've cultivated those relationships. And I would say it's also the same thing with fund managers. When fund managers are, they've already started to get close to deploying their first fund. They're already spending maybe a year, but they're not there yet. They probably have a year left, or like even 8 to 12 months left. They're spending that time kind of cultivating relationships with maybe new LPs. But if you can do it when you're not actually raising, then you're in a less stressed level. There's not really too much of an urgency, and you're actually taking time out to build a relationship with maybe an LP or even an investor as a human being versus kind of being in pitch mode. Because I'll tell you, like some of the startups and even some of the fund managers that I've backed, I've just kind of gotten to know them as people, and I just wanted to kind of be on that journey with them. So
absolutely. And I think you make a fantastic point, especially when you're going from that seed round to Series A and beyond. You're dealing with a different caliber of investor. So to cultivate those relationships, I mean, you and I both know these founders have to speak to 100 of me to get 5 of me to invest. So the earlier you start, you close your seed round. If you think you're a year out from that Series A, you should be already starting to cultivate contacts and say, okay, who are we going to reach out to? I like to think of it as a numbers game, because the truth is you only need one lead investor to believe in you, and the round will fall out. So, if you reach out to 200 funds, you might only get 5 that are interested, and maybe only one that's really going to step up to the plate and lead the round. So I completely agree. I think that's so important to start early. You don't know. And I like to say, you never know which email is gonna kind of lead to something. We've had random people reach out, and they ended up being contacts that introduced us to great companies. So I think it is so important to just, as the founder, reach out to every single Series A startup that you think might be interested in you, and start those conversations early.
Yeah. No, absolutely. I think that's really important. So tell me a little bit about kind of the sectors that you've invested in, maybe some background or kind of what you believe in those sectors, because I think that'd be really good education. And I mentioned this earlier, I come from like an aerospace background and a B2B SaaS like fintech background, but I've evolved and, gone into food tech, and I've gotten into, hydrogen energy. So I've kind of been pretty broad, just based on curiosity, but we'd love to kind of see kind of like your journey of, exploring different sectors, kind of what trends you're seeing in those sectors. I think that'd be helpful for the audience as well.
Yeah, for sure. As I mentioned earlier, we're industry agnostic. So we've really invested across multiple different industries, and stuff that we haven't had any familiarity with previously. So, I think for us, we just love kind of learning and seeing what's out there. So, for instance, like, I wouldn't particularly say that we're the most green family ever.
Okay.
But with that said, we found a great company called GoSun that has great solar products. Right now, they're building a really exciting new product. It's going to be a solar battery that goes on electric vehicle rooftops. So it can give you like 30 miles a day. So if you're just using your EV to go to your commute and back, it's a great option for you. Then that's not something that I ever thought that we would be involved in 5 years ago. But here we are. So, you know, the one thing that I will say is because we are so sector agnostic, we don't really get too deep in any sectors. And maybe that is to our detriment. But I do feel that we've gotten so much exposure to so many different things that are out there: construction, green tech. We have a company that does baby gear rental. Once again, not something I ever thought we'd be involved in, but it's a fantastic company, awesome founder, and here we are. So in terms of, you know, like general trends, obviously it doesn't matter what industry you are. You have AI somehow in your product stack. Yeah. Whether you know, was historically a use case for that industry or not, every company, every single sector has some type of AI incorporated into their products and platforms. You know, I always laugh because when we first started, it was AR, VR. Every company that you saw, it didn't matter if it was a virtual reality type company, they somehow found a way to integrate AR and VR into their products and platforms. Yeah. Then, of course, we had the big crypto boom. Every single email that I received was in regards to a crypto type company, a Web3 type company. And now it's that third, since I've been involved, that third kind of frontier of, hey, it's now the AI ML boom. So I'd say that's kind of the big trend that I'm seeing. It's like industry wide, doesn't really matter what we have one company that does they have basically, they measure your workouts using these Bluetooth cameras, and they have some AI capabilities to understand your face. So when you jump back on that weight bench, it knows it's you. I don't think in the past you would think of the workout industry as a big AI play, but here we are. So I think that's kind of the big trend that we're seeing more than anything else.
Do you think there'll be more AI co-pilots? Like if you're doing something, you've got kind of a companion that maybe checks what you're doing and helps you? And if so, like what are some industries that you think could be interesting in that space?
Yes, I'm laughing because I happen to be a very bad writer.
Okay.
So now basically every single thing that I write, maybe not quick emails, but anything that's, you know, a little lengthier, it'll go through some AI co-pilot to spit out, hey, you know, Jesse, you're terrible, and here's what you should be writing.
They've got Grammarly. Do you like that product? Have you used that one?
Grammarly's good. Grammarly, I definitely have used. ChatGPT is obviously great for it. You know, I'll literally say like, here's my paragraph, make it sound more adult. So, you know, I think it's more that it's just becoming more of people's day-to-day than anything else. You know, I think what's great for these companies is being able to integrate some AI search engines as well for industries that, once again, you would not have expected AI to be supporting them. It's there.
And I would say the concept of a prompt is pretty normal now. It's expected. So I think I told you when we were hanging out, like for my son, we created like a t-shirt company, and you can prompt something and it'll design a graphic, which I thought was really cool. So I think, and I wasn't like that taken aback by it. I was like, oh yeah, I was, and I actually thought about it. I was like, oh, that would be cool if there would be a prompt to kind of design something, right? So I think the concept of a prompt is becoming more and more of like a normal expectation.
Absolutely.
You know, especially, and I think there was,
I was just gonna say, if you go on companies' websites, bottom right, there's always a little chat icon, and it's always some AI engine in the background that's prompting you, and trying to get you to that right place. But I'm sorry.
So I got a perfect example. So like, I don't know if I show this to you because I just downloaded this last week, but there's an app called Captions. So for those people that are looking to kind of create short form content, you know, they want to create some thought leadership and post it on Instagram and TikTok. You know, about a year ago, I was using it because a lot of times if you're filming yourself and you want to put something on social media, sharing some thought leadership. What you have to do is you got to film yourself for like, under a minute, and then you got to give it to an editor, right? And then the editor comes in, they add the subtitles, they add like the little emojis and kind of make it look good. Captions automates that completely, and it uses AI to create the captions, and then also has like some emojis that are relevant. Like if you say like, hey,
really cool.
Here's advice to fund managers, right? It'll probably have like a dollar sign or something because it knows you're talking about a fund. So that was kind of interesting and like kind of groundbreaking last year. Now it's just kind of expected. Like, I don't think it's that big of a deal, but captions just dropped this feature. Let me see if I can just share my screen real quick.
Please.
But I think here, let me see if I can figure out how to do this. Share screen. But they have AI avatars now, which is quite crazy. So if you go to the captions app, and I played with this, it's freaky. But they have these AI avatars from all different, and they look all different, genders, all different types of, so this is AI generated. So what you can do is you can say, hey, write a post on what LPs are thinking about in the market. And the prompt will write out like a script. And then this woman right here will come in, and she's super realistic. I don't know if there's a video, but she will talk about it, and it'll create the emojis. And like, they have like all these different types of, avatars. Like they have blonde people, brunettes, all different diversities. But now in the future, it's like, you can create content. And I was blown. This is so realistic. Like you couldn't even tell. So, and then I think Reid Hoffman had something, he posted this the other day where he created kind of like a digital clone of himself, and it listened to like hours and hours of his podcasts. And essentially it was like a version of himself. So there was like a side by side, and you couldn't tell the difference.
That's like it just learned who he was and his voice, and
learned who he was, his inflection of how he speaks,
mannerisms.
And you couldn't tell the difference. And I think that the AI version looked a little more handsome, by the way. So I think at that point, you
very happy.
What's that?
I don't know if Reid would be very happy if he heard you say that.
Yeah, I mean, I don't know if I'm like big enough that he would even hear about it, but I don't think he'd care. But you're right, good point. But yeah, I think that opens up a kind of new medium for people to replicate themselves, because normally the way that you replicate yourself is you hire people, right? And you find people that are the right skills. But I think if you can hire digital workers that are maybe your likeness, maybe you can kind of share knowledge that maybe you author and maybe you architect, but then you kind of distribute that, because it takes time to film yourself and it takes time to like edit yourself. But if you're able to kind of get your message across without having to sit in front of a camera, film yourself, make sure your hair's not messed up. I wonder your perspective on the ethics of that, or if there's something wrong with doing that, in terms of kind of just scaling yourself.
Yeah, no, I think it's really interesting because, we always say there's nothing like founder-led sales. Mm-hmm. You could bring in 10, 12 salespeople. No one's going to be as passionate as the founder. If you actually were to create like a sales force that was literally just the founder and multiplied them, I think that would actually be extremely effective. It's like how many times do you hear companies that raised money, they want to build out their sales force, they hire 5 people, didn't work out. They weren't good enough. They weren't passionate enough. They didn't care enough to learn the products well enough. You don't have to worry about that if you're able to digitize yourself and duplicate yourself on a scale. So I think for something like that would be an amazing use case.
I think even just a sales force, right? I mean, and this is something that I'm surprised hasn't been built out yet, but each business is going to have their own unique types of objections. They're going to have their product education part of the sale. So I'm pretty confident if somebody listened, if some LLM listened to, 1,000 hours of the same calls over and over again, you're going to start hearing the same objections. You're describing the product in the same exact way. So you should be able to create some type of digital avatar that, you know, in their mind has already known how to address all of the objections and like move them to the close. So I think there's an opportunity. I think there, you know, I'm surprised there isn't something like that already where you just kind of like this. Because what do you do when you're hiring a salesperson? Obviously there's rapport. I mean, this is how I think about it, right? You're building rapport with someone, you're understanding what their goals are, understanding what their main pain points are, and then you kind of go into maybe like how you helped other people and how you've addressed that problem.
Absolutely.
And then you probably talk about the price, right? And then from there, it's really a binary decision where if they want to join or if they want to follow up. So I think in theory, you could use, you know, algos and kind of use training to kind of get there, especially if like the audio sounds like a human being, you know?
Definitely. And we actually have a comment over here saying it exists and they're an investor.
Yeah, someone in the audience said they invested. So interesting to learn more about that. But yeah, I think, you know, customer service, you know, I've called somebody to change. I've called, I think, you know, a company to kind of change my flight, and it was completely AI. You know, I mean, it sounded human-like. Yeah, it was human-like. I think it was like it was one of the, I think it was like JetBlue or somebody, but I was just like, look, I need to change my flight. And they were trying to, I guess they were obviously for cost savings, right? It makes sense for them to not have to have me talk to a person. And if they can kind of, you know, what are the main reasons why people call, right? They're trying to reschedule their flight got canceled. So I think if there's some basic logic that can pick that up and help you just kind of reschedule, I think that could be really interesting. So.
Absolutely. I mean, I think, if anything, it's going to very much disrupt the call center type of industry that has existed for years, decades.
Yeah.
Oh, look, did you lose me? Can you see me again?
I think I see you. Yeah, you're good.
Okay, cool. My camera just flashed off for a second.
Mm-hmm.
No, let me take that out. I think it was my monitor, so that was giving me some hard time.
Yeah.
Yeah. So, like an industry like that, certainly going to get disrupted very quickly with AI.
Yeah. No, absolutely. And then, you know, I know we got about, 13 minutes left. Any other sectors that you kind of think could be emerging? So AI is definitely like a hot space. The solar, industry. I saw something in my feed, I think a couple months ago, about like just concepts for Tesla. And I think it'd be interesting at some point if there was a composite material, like where like almost the paint is like a solar panel, and then you get all that real estate from like the car where it kind of generates some energy. So I think that could be interesting. And then I think like if there was some type of like cyber truck that was like also a camper, like, and you have the camper up, that whole thing is like a solar panel, right? So I think if you can like create utility with the solar panels and the real estate, like that could be really interesting to power the car, especially if it covers like a round trip of like a couple hours somewhere. I think that could be interesting.
Well, that would be massive. I know, there's some concerns about kind of capacity, and also, my brother is the tech guy in the background for us, but he says that Elon talks about that just the amount of real estate on the car itself could only create like so much energy. So how do you make that little energy that it can create very efficient, that you could use it for, as you said, a couple hours? I think that would be incredible. Something that I think I'm seeing more and more often, which I don't think it's something that we would invest in, but it ties back to your background. I feel like you're finding a lot more companies try and mine from space, mine resources from the moon, mine resources from space. Obviously, there's different properties in the solar system that can't exist here on Earth. So I know there's like specific materials that are created off the planet that really have a lot of utility. So I'm starting to see like stuff like that a lot, which is not something that I would ever picture that we'd see, but 2024.
There's people that are mining asteroids, and then I think there's also utility to manufacture products in space because there's no gravity. So that also helps to create some types of materials, which I think could create some innovation in the material sciences space. So that's also been something that's been interesting as well. So
yeah, we have one portfolio company that has a 3D printer that prints PCBs, the circuit boards, and they have a grant with NASA to do it in space.
Yeah.
Same reason. So they've been working on that for like the last year or so. So we'll see what their findings are from that. But it's certainly not, once again, not something that I was seeing 5 years ago that I'm certainly seeing more today.
Yeah. And we're both in New York. So what are some things that you're observing in the New York community, probably that you've observed in the last few years? One thing I'll say, to the activity comment, there's been a bunch of AGMs and LP community events earlier this summer, where I feel like last year it was kind of dead, like May to August, even September. But there's tons of events, with fund managers, with LPs, with founders. So I definitely see like a lot more community building, more than I saw last year. But I'd love to hear your observations.
Yeah, I mean, from a personal standpoint, I completely agree. I think in the last year or two, like WhatsApp groups and all these other roundtable email groups that certainly a year or two ago I was not a part of, and I'm certainly seeing a lot of them now. I think being in New York, as you mentioned, there are so many events. So it's such a bustling ecosystem for the startup space that I think for me personally, what's awesome is that there's no shortage of people that I can go on LinkedIn, find as New York City based venture investors and just reach out to and create a relationship. So I think not that it's new or a trend in New York, but I do think just having access to all these different individuals that are in the same world. The collaboration, I think, actually, I will say more startups that we've talked to in the last year or two are from other investors that we've had relationships with than in the past. I don't know reason if it's a tougher market, so people are trying to share their startups on a larger scale. But I do find that we're getting way more inbounds than ever before. And I do think, something that we talked about, another trend that I'm seeing, I feel like there's a lot more brokers than there previously were. I don't know why, but for whatever reason, I feel like there's a lot of individuals that are out there that have a lot of founder contacts, have a lot of investor contacts, and they're trying to marry the two and take a percent of the investment. And I don't think we ever dealt with one before this year. And all of a sudden, in the last 5-6 months, I have 4 I'm speaking to that have really good companies. So they come in all shapes and sizes.
What do you think are the pros and cons of brokers?
Yeah, I mean, look, I think founders are always going to shy away from using a broker. They want all the money to themselves. So I think there are probably great startups that have no problem fundraising that aren't going to use brokers. So maybe the deal flow isn't quite to the same level since those companies don't need brokers. So that might be a con. But I mean, on the pro side, we have a lot of great companies. Some have no problem getting investors, and we scratch our head. We're like, wow, okay, have at it, go get them. And then we have other great companies with great founders that, for whatever reason, struggle. So I think for those companies that, maybe they're not presenting the company in the right way or framing it in the right way, these brokers could do wonders for them and open up doors that, for whatever reason, they couldn't open themselves. And they're willing to give up that 3, 4, 5% for that access. So I think it's not for every company, but I think there are some startups that it's a perfect play for.
Yeah. I mean, I talked to a fund manager about this, and his opinion, which I think I agree with. I think, founder-led fundraising. If you're a founder or if you're founding a fund, usually the majority of it is raised on your own. And then, you usually kind of leverage a broker to maybe top it off. But, I haven't seen too many fund managers or founders say, hey, you know what? I need to raise my seed round. Can you just do it done for me on demand, and just close out my round for me? So I feel like maybe it's a supplement to what they're doing.
Definitely.
But I think the cons are sometimes if you've got brokers that are coming to investor events and then they're coming in and then their main purpose is to kind of like solicit maybe their brokerage services, and then it kind of maybe dilutes the curation maybe sometimes. So I think that's kind of the issue.
No one likes to feel like they're being sold.
Yeah,
especially fund managers. So I could totally see that perspective. I will say, I think, the start engines of the world and the crowdfunding kind of open the door for these brokers, because those crowdfunding websites, they take crazy fees, crazy percentages.
Yeah.
So I think if you're struggling to fundraise and everyone's sensitive to money being taken out of their hands, of course, but and you're sensitive to losing money, a broker, I think, is a better solution than the crowdfunding in that particular scenario. All these methods, I do think, have a place to play in this space. But yeah, it's interesting because I just something that I wouldn't have thought about before, and it's something that it has certainly, I've seen a trend more towards these brokers than I've ever seen before.
I would say, I think that's a challenge. I think a lot of people have, over the years, over the decades, people have tried to automate this, right? Like capital intros. They've got some platforms now that are trying to facilitate that using it. I mean, I think AngelList probably by far did one of the best jobs, but I think the only downside is, I'm trying to figure it out. So you're a company or you're a fund and you want to meet LPs. So I think you can go on there, push out your fund or your offering, and then it goes out to this large community of LPs. And then I think if you do close, whether it's startup capital or fund, LP capital, I think the business model is AngelList takes a portion of that. But I think the downside is, like, your LPs are also being exposed to other people's deals. So I think that's the whole reason why people have kind of gone through SPVs, because of that, the issue. So it's kind of a chicken and egg, right? You want to meet other LPs. I guess the model is like, look, if you want to meet other LPs, you got to show your LPs too. And then as a result, you might meet some new LPs that you didn't know. But in reality, people might actually be pitching their deal to your LPs also. So, some of your LPs that maybe have anchored you or believed in you for the next couple of years, they may see something else exciting and maybe not commit in the second, round, whether it's the second fund or the next round. So it's like, there's pros and cons, and it's kind of a chicken and egg. But it's worked, and I think it's a great model for it, because I doubt AngelList is really, I mean, they have great revenues probably from like the 8% management fee of the SPV, but that's not how you become wealthy, right? You become wealthy because you've taken a portion of maybe the carry or like the underlying holdings of like that company, right? That company has a massive, and you take a cut of that, and the companies and the marketplace is kind of doing all the work. But I think it's definitely different, I would say, probably when you get into more bigger institutional pension funds and endowments, because you don't see those people going into AngelList, right? So they're probably going into like Preqin, or they're probably going to some of those more institutional terminals to kind of get. And then the business model of those terminals is they got to crank out the subscription fees of those terminals, right? The $50,000 terminals. So they got to go pound the pavement and sell those.
100%.
So I think, but I don't think that automates the capital connection either, right? They're kind of a reason. So I think I don't think AI has completely solved like capital connecting yet, because it's still relationship based. But I don't know if you agree or disagree with that.
No, I completely agree. You're never gonna, same thing on the startup side, same thing on the fund side. You're never giving someone money unless you feel 100% comfortable.
Yeah.
I don't think, and maybe I'm wrong, but currently I don't think there's a way for AI to take over your due diligence process. It might be able to look at some financial documents and say, hey, yes, it's growing X, Y, and Z. Hey, this looks good based on what you're looking for. This looks good. It's never going to be able to replicate, hey, customer XYZ, why do you use this product? What differentiates them? And to me, like, those calls are so valuable and something that, I'm sure it's the same thing with fund managers. I'm sure they have reference calls all the time. Hey, why do you invest in this fund manager? So I think there's certain things that AI could certainly assist in with the due diligence process. Looking at bank statements, I'm sure it can grab all the deposits and try and filter out which one's investments and which one's actual revenue coming into the company, and say, hey, this is the revenue. I'm sure it would have no problem doing that, and that would be fantastic for us instead of my dad with his magnifying glass trying to go through these. But I don't think it'll ever replace those calls that you can have that you get so much value out of and so much comfort out of. So I think it's getting towards there.
Yeah.
I don't think it'll ever 100% take it over, though.
Yeah, and I think, look, I mean, on Zoom, this is kind of an interesting take, and I know we're at time, but I thought I'd share this because it was interesting to me. Over Zoom, you can see my mannerisms, you can see my eye contact, you can see if I'm engaged, maybe you see if I'm sincere. But what's interesting is if you go to dinner with somebody, you can see how they kind of treat the waiter, see how they treat other people, or like other different kinds of cues that you probably wouldn't see in a Zoom setting that's kind of already kind of framed and organized. So I thought I'd share that. That's kind of something that you can maybe pick up on that you won't see on Zoom. So, and
it's such a great point and I know you said we're out of time, but it's such a great point because when we first started, before the pandemic, that was part of our due diligence to go fly to wherever the founder might be or go meet up and have a cup of coffee or lunch or dinner, whatever it is. Since the pandemic, everything got so much more comfortable virtually that we kind of stopped doing that. And it's a problem. And it's definitely something that we should start doing again because there's nothing like face-to-face interaction.
I mean, maybe even just take him out for a drink. I mean, there was one founder that kind of got a couple drinks in and started bad-mouthing their competitors, which is kind of not, good form because at the end of the day, you're playing in the same ecosystem. So it's just kind of, like if you're seeing that and witnessing that, imagine if they, imagine what they would say about you as an investor, right? Maybe you gave them some feedback that they didn't like and they go out and grab a couple drinks and start, bad mouthing you. So I think sometimes it's good to grab a drink and let the truth come out,
That's right. There was a founder, and I know real quick, there was a founder that we liked over Zoom. I thought he was hitting his jewel. I wasn't 100% sure. We went to lunch with him. He was hitting his jewel the entire time. And we're like, okay, that's not giving us the warm and fuzzies. We certainly would want you to be having this lunch or dinner with a prospective customer and presenting it that way.
Yeah.
We didn't invest in that company.
Sure.
So that's something that we wouldn't have picked up on had we not had that lunch with them.
Yeah. I think too. I mean, I know we keep just dropping these nuggets. I promise I'll be done after this one. But one more nugget, which I thought on the fund side, which was interesting, was there's a certain level of professionalism. So you kind of hit on that. So from a fund manager standpoint, I think it was I forgot which person said this to me, but LPs kind of want that same experience of logging into their JP Morgan Chase bank account, right? The level of professionalism. When they come in, hopefully they see an investor terminal. If you're a founder, hopefully there's some portal that you come into. Obviously, if you're super early, maybe it's okay that it's Google Docs, but some type of professional, organized experience kind of will represent your brand. And, obviously you have to do things within your means. If you're a pre-seed startup, you might have to use Google Hangouts for now before paying the $15 a month for Zoom, right? But just kind of some type of level of professionalism, so definitely hitting the jewel like every couple minutes. There's a bunch of smoke everywhere while you're talking through your product market fit process. That definitely is not a good look, and it's kind of the level of professionalism which I think you're talking about. So
100%, exactly.
Well, hey Jesse, this was awesome. I feel like we hit on some of these points when we were there in person, but glad that we were able to share this with the community. And thanks for your time. And I'll see you when you're in my hood, and we'll get together.
Sounds like a plan. Thanks so much for having me, Joel. Pleasure.
All right. Yeah, likewise. Take care. Have a good one. Yeah.
Take care.
See ya.